Subscribe to our channel and click on the bell button to receive important financial updates faster than anybody else.
Friends, welcome to another video on your channel Profit in Equities. If you like our content, please don't forget to hit the like button. Also subscribe to our channel, click on the bell button and choose all notifications to receive important financial updates from our channel at the earliest. In this video, we talk about a dirt cheap small cap stock from the agrochemical space which should be accumulated on all corrections and has all the trappings to be a future multi-bagger. Please watch this video to know more. Now the company in question is Insecticides India Limited, which is available at Rs 571.75 and the face value for it is 10. The symbol for it is INSECTICID. Now this is an agrochemicals company. After a sharp correction in the stock over the last few months, Insecticides India Limited seems like an interesting pick from the agrochemicals space. The company reported a decent performance in Q1 FY19, while revenue growth remained muted at 2.3% year-on-year. Given the low share of generic products in its portfolio, EBITDA saw a decent 10% uptick. The management was able to substantially reduce interest cost, which contributed to the 11.4% uptick in net profit despite higher taxes and lower other income. Now, despite no uptick in product prices, the quarter gone by saw healthy growth. This was majorly driven by a strong uptick in volumes. The quarter gone by also saw the benefit from a lower base due to the implementation of GST in Q1 FY18. The management said it has exited some low margin products during Q1, which led to lower top line growth. However, introduction of higher margin products aided margin improvement. The company has strategically started exiting low margin products and is now focusing on launching new products and capturing higher market share in the higher margin product portfolio. This improved product mix is expected to further strengthen future margins. Now, IIL has a strong lineup in technical grade agrochemicals and formulation products. These are expected to drive volumes in coming quarters. The company has a strong R&D focus and intends to launch 6 to 7 new products every year. Also, the management has started focusing on the export segment and is planning to export branded formulations and technical grade agrochemicals to high growth emerging markets like Middle East, Africa and Southeast Asian regions. With rigorous registration rules, exports to the US and European nations are relatively more difficult and emerging markets seem like a thoughtful approach. Besides, it has also invested 200 crores for setting up a plant in Dahej. The management is planning brownfield expansion of its technical grade agrochemicals facility at Dahej. It is planning to fund the capital expenditure from internal accruals. With substantial capacity expansion on cards, there is an expectation for improved volumes and benefits of operating leverage to kick in the future. Now, IIL imports around 50% of its raw material requirement, with half of it being from China. Owing to closure of factories in China, depreciating rupee versus the dollar, and uptick in crude oil prices, input prices might see some uptick in coming quarters. But the company sees scope for an uptick in product prices, which would help in protecting its current margin. Moreover, the new plant, which is scheduled to be completed in FY19, would help it capture demand created due to the supply scarcity from China. It also augurs well for IIL's own raw material sourcing. With the government imposing restrictions on Chinese imports, this move is expected to usher in benefits for the company. However, one key risk to be highlighted here is that in August, the government banned 18 pesticides. The list includes 4 products currently manufactured by IIL that are to be phased out by December 2020. Sales from the 4 products account for 15% of revenue. Given the substantial share, this move could have an impact on the company's FY20 earnings. However, the company has a strong lineup of new products in the pipeline which are scheduled to be launched in FY19 and 20. There is an expectation for the sales from these products to offset the revenue impact. Now, the management expects around 15% revenue growth for FY19, which seems achievable. Margins are expected to see a slight improvement due to product launches in the coming quarters. Now, the stock has corrected substantially around 40% over the last 1 month and is currently trading close to its 52-week low. Post-correction, the stock is now trading at estimated price to earnings of 12 times. With the growth story remaining intact, the stock appears attractive. Now friends, please don't consider this to be a recommendation on our part. This research was carried out on a television channel and we'll be providing the link in the description section. Thanks for watching, and if you have not yet subscribed to the channel, please consider doing so.